watching this, you've probably heard of a brokerage account. But what you probably haven't thought about is how a brokerage account can have a similar effect on your retirement distribution income as a Roth conversion. So I want to reframe in this video how saving in a brokerage account as a strategy pre-retirement can be a form of income conversion in retirement. And you're going, wait, Forrest, I'm a YouTube guru. I've seen all the videos. No one's ever told me income conversion. Can you please explain this to me? I only know what a Roth conversion is. Well, the answer is I made that term up, but I'm going to explain to you why it makes sense and why you should pay attention, because this can be really, really important when you think about your retirement strategy. I'm Forrest Dutton. I am the owner of Brightworks Financial Planning. I'm a certified financial planner professional. This video is meant to be educational in nature. It's not personal tax or investment advice. It should not be construed as such, but I really hope you enjoy it. And now on to the video.
All right. So, welcome in, guys. Today, what I'm going to be doing is talking through this concept of what do I mean when I say a brokerage account can do income conversion. Okay, you probably heard the term Roth conversion, but I'm going to argue that the brokerage account can be viewed similarly. You just need to project it into the future and think about how it might be used in the future. So, let's take a case here. So, this is just going to be our test client, and they're going to be 60 years old. Okay, so they are 60, they want to retire. They have not pulled Social Security yet, and what they want to live off of is $130,000. Now, you probably need to know what are the other assets on board. And the answer is in this first case, we are going to say that they have nothing more than a $3 million IRA. Okay, now that's important. And the reason is every dollar of that IRA that was deferred, this is a traditional IRA, is going to come out as ordinary income. So this is what that would look like when that client goes to retire. So here we go. So backing into this, I'm looking here at a software that's going to help us kind of look at what our tax planning should show. And we're going to put $130,000 in here. That's the only form of income. Down here, this column is going to show capital gains. And in this case, there are none because everything is going to be income. So what I want to show you here is, and I don't think this is a surprise to anyone watching, but if we think about the breakdown here, this is all ordinary income. Therefore, if they are married filing jointly, we're going to subtract the standard deduction. And if we keep going down, we're going to arrive at a total taxable income and a taxable figure, which is here. So it's going to be somewhere around $11,498. So that's the tax you would pay on this distribution number. Now, the question is that the final distribution number? And the answer would have to be no. So if this client wanted to live off of $130,000, meaning to actually meet their living expenses, that would mean they would have to withdraw more money from their portfolio, which we already said was $3 million. Now, in that case, it just means that we have to increase our portfolio withdrawal rate, which is going to increase the sequence of return risk in this plan. So, said another way, this $130,000 living expense is not the end of the story unless you have cash on hand or CDs or money market accounts that's going to pay your taxes. So I think you can see that's not perfectly efficient. That's not really how we would prefer to do things. So let's talk through the brokerage account. And just to remind you, the brokerage account is going to have what's called capital gains treatment. So if you buy a stock or security in a brokerage account, you can open up this on your own. It's not something that you have through your employer. It's something that you can just decide to contribute as much as you want or distribute as much as you want when you want. So just to remind you, how does that actually flow through tax-wise? So remember this 130,000 minus the standard deduction, that number, whatever comes out from our adjusted gross income to standard deduction becomes what's called your taxable income. Now, here's why that's important. Because if we're looking into next year in 2026, if you have a brokerage account and you pull the money out and you're going to pull it out according to long-term capital gains treatment, and that simply means that you owned a security 12 months or more, if that is the money that or those are the securities you sell to get the money that you live on, you're going to be subject to the long-term capital gains rate. Now, here's why that's really important. Because if you're a married filing jointly, that means that if as long as that taxable income is less than $98,900, those capital gains are taxed at zero. So in my mind, this is the same as you treating this brokerage account as income conversion. So what I mean by that is when you go to distribute, how much of that income is shielded at 0%? Because if you think about what's a Roth conversion, defined, a Roth conversion is taking out more money that is going to be taxed and making it tax-free in the future. Now, what you've done with the brokerage is you paid tax on the front end, right? So we can never totally get rid of tax because you had to put the money in the brokerage account from your bank account after it already ran through your payroll, meaning you got paid either through your job, W-2 job, or maybe you pay yourself through your business. Now, that being said, you still had to pay taxes then, but later, if you distribute it the right way, you do not have to pay taxes again. So the reason I'm making this argument is because when you are in your working years, this is a have your cake and eat it too situation. So if you're a high earner, it makes a lot of sense for you to defer some of your income to the future. And that will allow you to have an IRA balance that you may or may not decide to distribute prior to your required minimum distribution age. But when it comes to the brokerage account, that is often an account that's overlooked, and it may be a reason why it's not always best to defer all of your income in your working years because you may want the flexibility to perform what I'm calling an income conversion in that year you contribute to the brokerage account. So, how do you define what that income conversion actually is? Well, there's a couple different ways to do it. Here's how I'd like to think about this. Let's say instead of having 3 million of an IRA, which was our first scenario, let's pretend that that 3 is broken down into 2 and 1. 1 is IRA, so that's 1 million. 2 million, just to put a dollar sign there so you know we're talking millions. This would be brokerage. Okay. So again, the purpose of this video is not to discuss sustainable withdrawal rates or how we would come up with that, but for the sake of math, just easy math, what we're going to decide is that we're going to take 4% out of that brokerage account. Now, there's one other piece of information we need about this brokerage account is we need to know how much of that brokerage account money is our money and how much of it is attributed to growth or earnings. So again, just splitting that out, the reason that's important is because say that you, over the course of your working life, you were a diligent saver, you reinvested dividends, etc. And of that 2 million, 1 million is actually your money. The growth on that, the difference between 1 and 2 million would be obviously another million to get to 2 million. So another way to say that would be, again, just for the sake of easy math, it doesn't always work out exactly this way, that in any given distribution, as long as we're distributing long-term capital gains, meaning securities that were held 12 months or more, basically we're saying there's a 50% cost basis in this portfolio. So just to give you another quick math here, so if we distributed, in our case, 4% for easy math from the $2 million, that's 80,000 that we're actually distributing. We want $80,000. We need $80,000. Okay, that's how much we actually sold. That's a realized amount, but how much of that is realized gain, right? Because 50% of that is not actually going to flow through to our capital gains. And I'll show you that here on the screen. Basically, I have the ability to kind of mirror what would come forth in our taxes in this situation, and it would be here. So it would be, I'm pointing to it, it would be these long-term capital gains right here. So in that case, we'd put a 40 here. So we want to live on $130,000, right? So there's our 40. That's what we actually have to enter here because we are trying to mirror what would actually happen in that tax year. What would flow through to your taxes? Okay, the answer is $40,000. So then the other question would be, okay, well, what else do we need to live on to get to that 130? Well, the answer is easy. So it's just 80 minus 130. So in that case, basically we're taking $50,000 from that IRA. Okay. Now we can debate about whether you should or shouldn't do that. That's basically 5% of that portfolio. But for the sake of math here, I just want to show you how this works. So then what does this actually mean when you say, okay, how is the brokerage doing in conversion? I don't get it. Income conversion. Show me how this works. So there's your 50,000. Your taxes show 40,000 on long-term capital gains, even though you pulled 80,000. So you're still living on the same amount of money. This is your taxable income. It's much lower. It's not 130 anymore. Now, because of that, your taxes are radically lower. Okay. So if you remember that previous number, it was a lot more than 1,850. Okay. Substantially more. Right. And here's why you're probably going, wait, I don't understand. The taxable or the gross income wasn't that different, right? It was only 90 versus 130. How can that be such a big tax difference? And the reason is because you did that tax conversion, right? Because of the way the money was pulled out. And I'm going to show you that here. This is how the income was actually distributed. Okay. So according to ordinary income, only 18,500 of that was subject to ordinary income tax because you're basically taking that 50,000 and taking away the standard deduction. That's where you got the 1,850. Now, here's what's cool. The additional 40,000 that was taken out from the brokerage account is taxed at zero. That is where the income conversion comes in. Now, here's where this gets really powerful. Say that you take this same scenario and you realize, wait, the reason I got to 130 in the first place is I knew I would have to pay taxes. I don't actually need to live on 130. I just pulled that out because I knew I had to pay taxes, right? So then you could start to live on less with the same standard of living, knowing that you're not paying taxes, right? So in this case, the difference is somewhere around $9,000 to $10,000 in terms of what the tax difference is between there. You could take that monthly amount and you could apply that to your yearly annual expense number. Then you become more efficient. Now, this also can be supercharged prior to retirement. Say that at 59, this client couple decided that they wanted to give when they retire. So if that's the case, what they could do is take some money and they could put it in a something like a donor advised fund and front load that because that will lower their taxable income in their highest earning year. And if it doesn't offset, if it's not able to be offset completely in that year, it can carry forward 5 years. So this line item here, okay, so we're going to go here to, sorry, it's up here. This line item of 40, right? There's a there's a netting there, right? So if you already had carryover losses, then you don't start at zero, you start at negative. So if you start withdrawing capital gains, you would have even more benefit to take money here from this distributions, and you could decide to maybe even do some traditional conversions and still live on the same amount of money, and you're really helping your tax burden a lot more. Now, I've showed you the original, which is $3 million in a portfolio. I've showed you 2 million in a brokerage and 1 million in an IRA. Now, what if you just had all 3 million in the brokerage? Now, I realize this is not common, and I'm not even saying that I recommend that because for most people, when you are in a high marginal tax bracket, it makes a lot of sense to defer some of your income. So I'm not going to model that scenario, but I think if you just take this to the logical conclusion, you would realize that that would be even more favorable, and that would allow you to fill up that bracket or bucket, so to say, right? You could fill up more here while living on less and taking more from the IRA, and you would actually come out better and be able to do a traditional conversion. But I want to introduce this. So in this case, what you did is you converted $40,000 of income in that year, an income conversion, what I'm calling it, right? So this is obviously not an official tax term, financial term. I'm just telling you that's how you should view your brokerage account. So anytime you decide not to defer income and you put it in a brokerage account, just know that you are producing a future income conversion based off of proper distribution and tax planning. And you should do that in conjunction with an appropriate financial professional. So whether that's a financial planner and CPA, whoever you trust and know, that's the person that can really help you with this sort of thing. So hopefully this video was helpful and helps you explain what I mean by the term income conversion. As always, please like, comment, subscribe. I want to know what you think about this, and I want to know if you thought that this was helpful. Love to see what other content that you want to see. And as always, I hope this helps you be more prepared when you go to consider your own income conversion. So, take home message, consider that brokerage account contribution earlier rather than later, because what you're doing is you're producing income conversions for your future self. Thanks.